Disney just reported earnings, and the stock tanked 10% right after. On Wednesday, May 10th, earnings were released, and these are some of the top numbers. So total revenue was $21.8 billion, an increase of 7.6% year over year. Net income was $1.5 billion, an increase of 149.2% year over year. And if you look deeper into this graphic right here, provided by Motley Fool, gathering information from Disney and putting it in a nice graphic, we see more data, but the main things I wanted to focus on were the Disney Plus streaming numbers. And this is what I believe is the main reason why Disney stock tanked. So here we go. But also before that, I want to talk a little more about Disney Plus. So here's some notes and some information that I pulled up for this video. So the launch of Disney Plus 3.5 years ago sought to insulate the media giant from its declining revenue from its cable service. So they wanted to bring in other ways to enhance consumers and grow revenue from consumers while they were at the same time decreasing the revenue that they were giving to cable companies. Because as we know, cable has been a very big trend going downwards, and people don't really use that anymore. So to give Disney its best chance for competing against competitors like Netflix, they wanted to flood the new service with loads of content. And this was their way of trying to lure as many subscribers as they could. The problem is this costs a lot of money. So from Q2 of 2023, or at least fiscal Q2 of 2023, Bob Iger says this from the earnings call. He says, "We realized that we made a lot of content that is not necessarily driving subscriber growth, and we're getting much more surgical about what it is we make." He told his investors during the company's second quarter earnings call on Wednesday. So this led to this whole series of investing so heavily into content led to expenses ballooning to nearly $30 billion in the last fiscal year, which is pretty substantial. As we can see in our little graphic right here, we had $21.8 billion for revenue in the first quarter. So right there, expenses from streaming would totally obliterate that amount and 50% more when we are looking at the expenses from streaming and creating content from the last fiscal year. So that's a very large number. Some other information I wanted to chat about was, while these expenses are very high, Bob Iger is aiming to lower spending by at least $3 billion over the next few years. And this is going to be as part of a restructuring plan that he revealed back in February. So another thing that as Disney has had this content out for longer, they're noticing what kind of content drives subscriber growth, which is what they want, as they want to increase revenue per subscriber as well and make this a more profitable endeavor that they go after. So this is where Iger says it's critical that we rationalize the volume of content we're creating and that we're spending to produce our content. And one of the quotes, see if I can find this, or I can just kind of wing it. Basically, Iger is talking about how they're really focusing more on profitability as opposed to strictly subscriber growth and or pumping out more and more content, because obviously if you keep spending ridiculously and you aren't getting a whole lot of return on that investment, it's not very worthwhile, and owners and shareholders, and really just if you're in the stock market and you're trying to perform for shareholders and benefit the company overall, it doesn't make a lot of sense to spend a lot of money on something that doesn't ROI. So a couple things about Disney that they're doing. Again, I guess here's kind of the quote I was looking for. At Disney's Q2 earnings call, Disney discussed its need to chase profitability over subscribers. And over the last 3 months, this is a big thing that really hurt Disney and their stock price over the last week, and what caused it to fall nearly 10%. Over the last 3 months, Disney Plus had a surprise loss of 4 million subscribers. Meanwhile, they were expecting to gain over 1 million. So that is a huge difference. That's over 5 million difference between where subscriber levels were expected to be. one way Disney plans to boost profitability is to enact price hikes for Disney's ad-free tier. So this could be beneficial, however, there are some issues with this, as we could expect. Now, raising prices helps boost profitability, but the question is, how long until consumers stop paying? Another thing to consider is many people are paying for multiple streaming services. People will spend for Hulu, Peacock, Disney, Netflix, all these different services. And the question is, how often and how much is this going to keep going on until people realize that this is basically turning into another cable TV style fee where it's just a large number and a large amount of money they pay monthly, and they're probably going to realize they should start cutting the cord on these streaming services. So as many people are pulling back, it will be interesting to see how many end subscriptions as prices continue to go up and as we continue heading towards trickier times in the economy. So now I have a question for you. How many streaming platforms do you use and how many do you pay for? Also, have you considered ending any, and have you actually ended any? Curious what your thoughts are, and I'll leave my comments in the comments below and I'll let you know my answer to those questions, but just want to hear what you guys' thoughts were, and it'll be interesting to see what happens with these streaming services and people's subscriptions to streaming services in general. All right, thanks guys.